Thank you very much, everybody, for having me for breakfast and for having me back. I was delighted to do this last year, but I have a short memory. I completely forgot how many people are in this room. I am absolutely terrified right now, but I'm going to do what my father always told me to do in public speaking. If you're nervous, you just try to imagine that everybody in the audience knows less about your topic than you do. You actually know a lot more about my topic than I do, because what I'm here to talk about is U.S. exceptionalism, economic exceptionalism, but it really comes back to businesses like the ones in this room. I was really excited to have sort of some of the preparation calls with the team with CenterState CEO and to look through the report, because a lot of what you are reporting in the survey is similar to what we're seeing in nationwide trends. And I have to say it brings us a lot of optimism. So our capital markets forecast this year digs in on the roots and the reasons for U.S. economic exceptionalism. The U.S. has remained a pretty steady share of global GDP, about 20 to 25% over the past 40 years. A lot of other economies have not been able to do that. In the full report, we describe how Japan was ascendant in the 60s, 70s, and 80s, and then sort of topped off in the 1990s and started losing share. China, over the past 20 years, has been ascendant and is now really floundering and flailing and looks like it's going to be losing share. But somehow the U.S. keeps powering out of struggles in a way that other countries have not been able to. So what we did was to dig into those things. And in the full report, we go through a lot of the pillars or the drivers of U.S. exceptionalism, economic exceptionalism. You probably won't be able to read like all of this, but the U.S. is that top row, and then we have the top 10 developed economies going down the side, and in the full report there's also the top 10 countries in emerging markets. And what we did is we ranked all of them across some of the familiar things that would drive an economy: capital markets, the ability to attract capital and investment, infrastructure, demographics, education, labor flexibility, the fiscal response to challenges, and then critically, innovative capacity. The capacity and the wherewithal and the inclination for firms in an economy to innovate. And that's going to end up being critically important for what the U.S. has been able to do coming out of this COVID period. The U.S. is about 2.3% below its pre-COVID trend. This is as of quarter 3. We just got the quarter 4 data, so it'll be a little bit closer now. But as of the third quarter, about 2.3% below. Now that is better than most other countries, certainly better than most other developed countries. Taiwan, as you can see here, is actually above its pre-COVID trend. It turns out it's very good to have an economy that relies heavily on semiconductors in an environment that has pivoted more towards a virtual world. But the U.S. remains the best performing economy as we move out of this recession compared to other large economies. And that has been true for stock markets as well, and I won't talk that much about that part of our report today, but it is available online. One of the most important drivers of the U.S. exceptionalism has been flexible labor markets. So this is one of the columns that was in that full table. The U.S. unemployment rate spiked during the pandemic up to close to 15% and then came back down. India, same thing, but a lot of other developed economies, shown here, Germany, France, we don't show all of them, didn't really have a move up in their unemployment rates. Was that because they didn't experience the impacts of the recession, of COVID? No. They actually had programs put in place pretty much across all of Europe and in some other places that were intended to help people. It kept them on payrolls, kept them paid, subsidized through taxes they paid. It was modeled off of a Germany program from the global financial crisis, and it basically kept people on payrolls. We had a little version of that with the PPP, which was helpful, but we didn't do it en masse across the economy. So what it did is that it kept a lot of people on those payrolls, and even before the pandemic, I think a lot of places in Europe, especially Southern Europe, are famous for having these very challenging labor markets, right? If you hire somebody, you'd better be ready to keep them employed until their ripe old retirement age of 55 or 58 or whatever it is. It makes it so that people are less likely to hire. In the US, we have more flexible labor markets, and as challenging as that can be for individuals, it's also helpful for individuals. So the column, the ranking column that I had on the first slide, reflects not just the ability of businesses to hire and fire and reshape how they make their goods or provide their services, but also the ability of employees to move, to carry their benefits from one employer to another, the ability to seek out another job. And what we have seen is that because of the setup of the US labor market, it has been more flexible, obviously challenging for some, but it has enabled businesses in the US far more than in other countries to retool their mix of capital and labor, invest in technology, and make the best use of labor. And that has been critical in the performance of US companies. There's also a lot of new business creation and innovation and productivity, investment in new softwares to deal with the new environment, and then also to deal with the challenges of the demographics of the US. We have the slowing labor force growth, slowing population growth. We've had a drop-off in immigration over the past couple of years, and that creates a lot of challenges. So businesses have not only innovated within their own companies, we've seen dramatic business creation. So the orange line is the creation of businesses across the US. The chart starts in 2007. You see you get that 50% increase from 2019 to 2021, and it has remained high. This data goes through the end of last year. It's not as if there was a bunch of business creation just in the wake of COVID and then it died off. It has remained high. Small businesses, medium businesses, the infrastructure, the availability of capital, the inclination and the entrepreneurship to spot a changed economy and to move into a gap when somebody sees it has been critical in the US's ability to emerge and to remain at the top. On the left-hand side, this is not the same data. This is coming from a MasterCard report of the opening of new businesses. And you can see from 2019 to 2020 that the US was not quite at the top, but it was near the top. And if I would go back to that initial table, you would see basically that the US is not necessarily at the top of every single category, but it's at or near the top of every category. And that really, the combination of all of those factors is the reason that the US has been able to outperform. The other driver of the US outperformance was stimulus. Now, the first two that I mentioned, the flexible labor markets and also the tendency to innovate and our entrepreneurship, were sort of good, unambiguously good. Maybe some challenges with the labor market, and obviously that can be challenging for individuals. But this third driver, stimulus, has both a positive and a negative impact. This is what economists say, right? There's no such thing as a free lunch. You can't dish out a whole lot of stimulus without having some sort of payback at some point. But first, just on the size of the stimulus. For the US, 3 major rounds of stimulus was 25% of GDP. That far exceeds the next highest, United Kingdom, at about 19%, and well more than the advanced economy average of 15%. Emerging markets much lower. And it's not just the amount of fiscal support and stimulus that was supportive of the US economy, it was also the design of it. The design was to get dollars into individuals' hands. And have them make decisions about where they needed to spend it and help keep businesses afloat and to provide that bridge from pre-pandemic to post-pandemic. A lot of other countries had large stimulus, but would be more concentrated in infrastructure projects, which are slow to start up and don't put the dollars in as broad a number of hands. Now, I'm not here to weigh in on whether the stimulus, the form of it, or the amount was good, bad, or indifferent, if it was good policy, if it was finely tuned, if it was the right policy. We know that it had a lot of issues. But it remains the fact that it is one of the drivers that helped us get to where we are today. But as I said, there is a downside to this, and it's because of one of the risks. It's because of the impact. One of the measurements on that first table comparing all of the countries was the current fiscal state, your debt to GDP ratio. And as we'll see in a minute, there's going to be some payback for the amount of stimulus that we did during the pandemic, but also the amount of spending and the driving up of deficits for 10 to 15 years leading up to it. But before we get to that, the outlook for this year, we remain very positive. It looks like the decimal points are being cut off here or something happened, but last year finished at 2.3%. That 2 -- should be 2.5%. Very strong quarter to end last year. It was reported last week, so the final quarter at 3.3%, very strong economy. Business CapEx has slowed in the face of higher interest rates, but consumers continue to power ahead and businesses are still investing and intend to invest and have a positive outlook. Nationwide surveys, CapEx intentions are very much like your economic forecast and the responses of all of you, is that they see their business as doing well and plan to expand in the future. And that is very positive. The outlook for this year, for 2024, we do have positive. It's 1.8%, which is below trend. It's below that 2% level, which we think of as sort of the neutral growth rate. And that is important because not only does it keep the economy's head above water, but it also enables the stress on the economy and the inflation pressures continue to move down. And that's going to lead to the Federal Reserve cutting interest rates later this year, we believe. Probably not today at 2 o'clock when the announcement comes out, and not at the mid-March meeting, but probably at the May 1st meeting would be the first time that we expect to see an interest rate cut. At the most recent, before today's meeting, the December meeting, the FOMC, the Federal Reserve, that's the acronym for the Federal Reserve, was projecting 3 rate cuts, so about 75 basis points for the short end of the curve. This is overnight borrowing. And we think that that is still too pessimistic. Inflation is already, for the past 6 months, running at the Fed's target of 2% for the past 6 months. By the time we get to that May meeting, we'll have 3 more inflation reports, and inflation is likely going to be running right around 2%, perhaps lower than the Fed's target for 9 months. Chair Powell and others on the FOMC have clearly stated that they need to cut interest rates before inflation hits 2%. If I was down there and knocking on the door, I'd say, hey guys, we've been there for the past 6 months, and we're going to be there pretty soon, and they know this. They are going to, what I think we'll see today, both in the 2 o'clock announcement and also the 2:30 press conference, is what I think of as a slowly turning the battleship of communication, of Fed communication, and guiding the market towards lower interest rates. And even though they've said 75 basis points, and even though today and even in May, on May 1st, when they first cut rates, I think, that they will be saying it's tenuous, it's going to be slow. As inflation keeps coming down, that they'll end up cutting more this year, and that's why our orange line is showing 125 basis points of cuts in calendar year 2024. And this impact is, again, a testament to economic exceptionalism. It is because businesses have managed to deal with high wages, higher interest rate environment, challenging supply chains, and all of the other things that are facing all of you, and still not pass those price increases on to their customers in a big way. That's why inflation is only running at 2% over the past 6 months. And we're going to see the impacts of that, as I said, as the Fed factors those things in. Now, I'm not going to do the stock market superiority theme, but that is an important item for our investors and for our clients. I will just say that the U.S.'s leadership in equity markets has very much been driven by the kind of things that I'm talking about in terms of economic exceptionalism, and that we would expect that to continue. I will talk a little bit about that risk that I had noted. So there are some risks. One of them is detailed in the report. I don't have a slide on it today, but it is demographics and the slowing demographics. The ability to find skilled labor is challenging, and it's obviously challenging in central New York, especially with the new investments coming. And our outlook for that is, even though it is a risk, that continued productivity growth, and especially artificial intelligence, is going to be a real game changer over a multi-decade period in terms of businesses' abilities to handle the challenge of less labor being available. The other risk that I've already mentioned is the US debt situation. Now this is a very busy chart. This is what my mind looks like when I'm sitting at my desk. I apologize for this. There's just like words and lines everywhere. But there's important messages on the chart. This is the debt to GDP ratio. So do you want to loan money to the US government? Do you want to loan money to a business or to a person? What's your debt and what's your income? Basically is the question, right? Debt to income. Well, for a country, that's debt to GDP, and that's the way that we think about it. Chart starts in 2000, and the US has just recently hit the 100 mark, 100 debt to GDP, so total debt being the same as GDP. That, for a lot of people, is sort of a threshold where it could keep moving up. And indeed, the projections, that dotted orange line, is for our debt to continue moving up. And that line doesn't look that scary here. Part of the reason I almost didn't put the blue line on is because we needed to have a different axis there and convince you that the orange line is scary, but trust me, it's scary. I also wanted to include the blue line because that is Japan's debt to GDP ratio, shifted 22 years. Japan's economy stalled out in 1990, not because of a property bubble that bust, that's the first thing you'll see if you search for this, but because they had built up so much debt that they were unable to respond to a slowing economy and slowing demographics. They had built up their debt by about, from the 58% mark to 93 debt to GDP ratio, 1982 to 1985, those 13 years, and moved up to pretty close to that 100% level just before and just as they were having some of their economic challenges. That's one of the things that challenged their ascendancy back then. Well, as we're showing here, the US has done pretty much the same thing. Our debt to GDP ratio has increased by 36% from 2010 to 2022. I chose a time frame that both matches up with sort of Japan's run-up in debt, but also straddles both political parties, so I don't get myself in trouble when I talk about debt to GDP ratio. Both sides of the political spectrum have done it. So this is a major challenge. It's going to drive up net interest costs, and that ends up crowding out private investment. This is just the credit card bill for the US, the projections as a share of GDP. We've been there before in terms of our credit payments as a share of GDP back in 1990. We're not quite there yet, but it is projected to keep rising unless we do something about the structural deficit. Now, I know I'm a dismal scientist, that's what people call economists, but I can't leave you with all of that pessimism. I've got to finish with some optimism. This is entirely manageable. Entirely manageable. Our calculations, similar to others, is that this year that we have this $800 billion primary deficit. That means the deficit before you factor in the interest costs. Our calculations are that you'd have to reduce it only by 300. You can still run a $500 billion deficit and keep that debt to GDP ratio at 100. This is what would be required to keep it at 100. We would actually like to cut more deficits and have it be bending down, that previous orange line be bending down, but these are the calculations just to keep it flat. How do you cut $300 billion? A lot of places I go, people say, we need to cut spending. Okay. If you want to cut discretionary spending only, 16% cut in spending. That would cause a recession, fairly deep one in my opinion, and I also think it's a political non-starter. Do you want to raise taxes? Individual income taxes, more than 12%, you'd have to raise them. If you want to raise income taxes on a specific segment, it's going to have to be higher than 12%. That causes its own challenges too. You want to raise corporate taxes? 63% hike to close that $300 billion gap, and we all know that there would be dynamic impacts. You know, corporations would move somewhere else. But the real positive thing is that last bullet. And this is why I say it's entirely manageable. If you combine the approach and go across all expenditures and all revenues, you would only need a 3.1% increase in revenue and a 2.6% reduction in spending. Now, I know that there are businesses in this room who have faced more significant challenges than finding 3% revenue or a 2% reduction in spending. U.S. economic exceptionalism that's centered on businesses comes from those kind of decisions that are having to be made every day, and we need the leaders in D.C. to make those kind of decisions, because as I said, it's perfectly manageable. We're optimistic about the economy this year. As I said, we're expecting what some people will call the soft landing, but at 1.8%. I find that very encouraging. And with the Federal Reserve cutting interest rates and inflation coming down, I look forward to it being a very successful and manageable year. And I wish you all the best of luck in your businesses. So thank you very much.